So first one I will do is the question by George. So this is good. We can add it to the Q&A database. So if you see any strategy, and let's say one of the strategies or the one, for example, in the free downloads, and you want to use that strategy. So basically you need to load it into SQX. So you can load it in Builder, which is a strategy from template. It doesn't have to be a template, you can use this one, but of course you should always use the retester. So let's say in retester you go load and you load a strategy. Once the strategy is loaded, either retester, optimizer, or builder, or Algo wizard, in any where you load it, you need to double click on the strategy. Once you double click, you should go to strategy config, and you can see now the strategy that I just double click on, it has the red text is the differences between the current setup and the strategy setup. So the easiest way you can set this is to apply the strategy configuration to whatever you are. But of course you can apply it to the builder or the optimizer from here also. But since we are in the retester, you can just say apply, and it will say it will overwrite whatever is currently done, and then it should match everything. Now sometimes you click apply and it will still have some red text. For example, here I used the es.d data from SQX, but for example if I use TradeStation data and you don't have TradeStation data, so it will show up here. It will say this, whatever symbol mine is called at es.ts, it will show it in red, and it will say, well, actually here it is. Oh, but it will show up anyway, because I have it. So it will say, well, this data, you don't have it. So it will show up in red. So sometimes even after you click apply config, it will still have some red text. So you need to take care of that. Anyway, so once you apply, now you can retest, and then it will be exactly like how I designed it. Because of course it will pick everything, like it will pick the right engine, the right time frame, the correct everything. So that's how you test other people's strategies. Always double click, go to strategy config, apply strategy config, and then you can retest. It's good to calculate on daily and execute on lower time frame. You mean use this setting in SQX? So let's take this example. Let's say you're trading, I don't know, let's say you're trading the RSI, or let's say you're trading the close above the 100-day moving average, okay? But you want to enter on the same day. So you can use the daily time frame to calculate the condition, and then use the intra time to enter. Like there is no good or bad. It depends on what you want to do. If I'm trading daily time frame, like if the signal is on daily time frame and my entry is the open next day, then I will just keep that on daily time frame. There is no need for intraday. But you use intraday, maybe let's do this another way. So let's say you're calculating the ATR on the daily time frame, but you're using the breakout intraday. So that's a good condition. So let's say you're calculating, let's say if the close is greater than 2 times ATR. So I will put multiplication, and then here I will put number 2, and ATR. So this ATR, I want to use it on the daily time frame, because currently if I use this and my data, let's say, let's pick the ES again. So this is 24-hour data. Yes, I'm picking the 1 hour now. So this close and the ATR both are calculated on the 1 hour. But I want only to go long when the close is higher than 2-day ATR, both for daily. So then I need to pick the second chart. So you can add here, or you can add here. Single chart, we will add another one, and I will use es.d. So this is daily time frame. And then I will come to ATR, and now I can pick that one. And I will pick the close of daily ATR. But this calculation will happen intraday. So if the close of yesterday greater than 2 times the ATR of 2 days ago, or let's make even one today. So let's pick back here. So let me explain this probably here. So if let's say this is the close yesterday, and we are here today, somewhere here. If my price reaches a point where it's the close plus 2 ATR, let's say that level is here. So during the day, if my price reaches this point, I will go long. So that's what I'm doing here. If the close today, which is the hourly time frame now, greater than 2 times the ATR plus the close of yesterday. Sorry, let's do this again. So if the close of current time frame, which is hourly time frame, greater than the close of yesterday, which is the daily time frame, plus 2 ATR of the daily time frame. So I make sure here I pick the daily, and I make sure here I pick the daily. But I'm trading intraday. Then in that case, now I'm using the daily time frame and using the intraday to trade. But if my condition is just the daily, let's say close of today greater than SMA of, let's say, 100 days ago, then in that case I don't need the second chart. It's both are calculation on the daily. I will trade the next day. Then I don't need the intraday chart. Again, there's no right and wrong. It just depends on what you want to do. What you're doing here, so if this is builder, then builder will find conditions to trade on both these charts. So you're adding conditions here, 1 to 2 on the daily time frame, and no conditions here to enter on the main chart. Because you can do that, yes, you can add, when you are in builder, instead of building on one chart, you can build on 2 charts. And now you can have different things done with these 2 charts. So let's say you can have the second chart as only the signal. So let's take one, and maybe the second chart is not even the ES. Maybe you take the let's see, the 5-year. It's so this is the 5-year. So you can build strategies on the second chart like this. So it doesn't have to be the same one, but of course it can be the same one. So I can pick ES here, and I can pick the ES 24 hours. But this is different because here now you're building in you are using this as a condition. What we try to do in Algo Wizard is calculate a signal on the on the daily time frame, but we're just picking a better entry, because if this happened intraday, I want to go long right when the condition happens. So again, to summarize, no right or wrong, it just depends on what you want to do. In SPP, what is the difference between green and red, even though one variable? This shows you, yeah, like you mentioned here, the highest and lowest results that you got, because in SPP you're changing the values of that variable, and then this will give you the range, the highest and lowest, correct. And then LT, could you explain the standard deviation, SPP, cross-check optimization, and the criticality of it for mean reversion strategies? Seems very hard to achieve. Passing the optimization cross-check test. So you're building something using the standard deviation, and it's not passing in SPP. I think that's the question. So SPP, like it doesn't have a preference of what have you used. Like it will not punish you if you use standard deviation and then reward you if you use, let's say, I don't know, ATR. It doesn't work that way. If it's failing, if the strategy is failed, so it's that's it. It's failed because it's not robust enough. Also, bear in mind that the SPP is not a 100% correct methodology. So I mentioned this before, both WFM and SPP, they both have false positive and what's the opposite of that, whatever you call it. Basically, when you test with those methodologies, you will have some strategies that are okay but will not pass. So for example, you bring a strategy in, it will not pass SPP, but it's robust, so it might pass walk forward, or the opposite, it could pass walk forward, but it could not pass here, it fails, but then it passes SPP. Both of these are not perfect. I can give you an example right now. So an 80 period trend following is robust. It doesn't matter what you do, it is highly robust. In fact, billions and hundreds of billions of dollars trading the 80 period moving average to go long and to exit as a trend following system. Yes, it's not used alone, but let's pick that one. And if you test that one, for example, let's say in walk forward matrix, it will show up as failed. But we know it's robust. There is no point in checking that. But if it checks out as failed, that doesn't mean it's not. We know it is robust. The only time that these helps you is when you build really fast strategies that it's hard to check the robustness. So let's say, I don't know, let's say you say I go long at 9:05 a.m. and I will sell at 9:30 a.m. Last 2 years, this strategy works very good. But then you test it on longer time, it fails. So then you are puzzled. Does this work? Does it not? Then the SPP and walk forward, it's an automated way, and it will say no or yes. The advantage is you don't need to babysit. Like, for example, if I'm testing trend following, I'm designing everything, and I'm actually watching the charts and do other tests, bringing in Excel. This is for automation. So for automation, if let's say I run 1,000 strategies, I only get, let's say, 5 that are robust, but in reality they are 7. 2 of them, they just went like they weren't robust based on SPP, but they are. Let's say they are, but SPP failed them. Well, that's okay, because you already got also 5 because it's automated. So it's not like you're babysitting the computer to find these strategies. You will do the workflow once, and then computer will find robust strategies. So even though it has this disadvantage, I wouldn't worry much about it, because with automation you will get many. So they are very beneficial because you can automate them, but they are not perfect. So if your strategy is failing, I would say like it's okay. Don't worry about it. But if you're saying that it's failing because of standard deviation, then no, that's not a, because it doesn't know what you're doing. It's only manipulating whatever variables you have. But of course we know that it works. We know like standard deviation will work in mean reversion strategies. It's one of the pillars of mean reversion strategies. So we know it works definitely. But like I say, probably for whatever reason, maybe one is a lower threshold. Maybe that's why it's not working. Anyway, but it has, at the end, it has nothing to do with SPP. So first thing I would try, whatever your strategy is, increase this, make this 2, and see if it makes a difference. If it makes a difference, then that is part of the robustness. So 2 is more robust than 1. And then B-Trader correlations. So do you use the correlation checks in SQX? Or do you have different process for checking correlation amongst your strategies? Do you eyeball your strategy correlation or use automated way? Could I use optimization method for, say, operations research to find the best strategy? So correlation only comes when you're building a portfolio, because if you're not building a portfolio, no point in correlation between strategies. So let's say you're building a portfolio. Definitely correlation in SQX is the first way to do it, because it's really easy. You just load the strategies, combine them in a portfolio, and that's it. You get a correlation of open position and profit and loss. Now, depending on your portfolio, I wouldn't worry about, I mean, both are important, profit and loss and open positions. Because let's say a strategy is correlated with open positions, but they have different profit and loss. So that's very good. That's not a disadvantage. The problem is the amount of money you will need. Because obviously, if both of them having open position, that means you need more capital, yes? Because they are trading the same capital on the same day. So theoretically, you need double the capital to trade. So that's the disadvantage with open position. But in terms of reducing your drawdown, you want the profit and loss. That's the more important. So let's say you have, this is curve 1, and let's pick this color, and let's say this is curve 2. Let me try to time it. Okay. So the result here, that when this is up here, this is down. So these guys will do well because it will reduce my drawdown. Remember, at the end, it will add these two values. At the end, if this is making, let's say 10,000, and this is making 5,000, so the total profit will be 15,000. But at this point in time here, the drawdown will be less because they help each other. So this is profit and loss correlation, and that's what it's that's what you're showing here, profit and loss. The open positions, they might be open at the same time, or they are not. If they are not, that's really good because it will reduce the requirement for the money you need to trade those strategies. If they are correlated, then you will need more money to trade the same strategies. And do you eyeball? No, there's no point in that. And could I use optimization to find the best strategies? Yes. So not optimization. Once the strategy is done, you will not touch that strategy. Now you want to match the best strategy, and the best way to do it is Excel, actually. I mean, of course, we just mentioned that here, it's really good. But in Excel, you have, let's say, more flexibility to do the correlations. You can do here, that's it. You have profit and loss and number of open positions. But also you might look at how long is the drawdown, maximum consecutive winners and losers. So there are other factors to look at. But in the beginning, let's say you're building your first portfolio, you just added 5 strategies. No need to complicate things. Just look at the profit and loss. You want less correlations there, so it will help in the drawdown. And of course, it will show up in the drawdown figure of the portfolio. It will be less. And then you want less correlation with open positions, so you use less capital. Now, this is only a beginning, yes? This is like, let's say, the bigger picture. But then you need to do Monte Carlo testing to find how much capital you need. But this is a great way to start. Once you have, like, let's say, I don't know, 200, 300 strategies in a data bank, then you need a better way to find, to reduce your correlation. So also you're not looking, this is a tip, you're not looking for zero correlation. So anything below 0.3 is good. The lower, the better. But anything below 0.3 is good. And next step, 0.5. So above 0.5 is not good. Between 0.3 and 0.5, let's say it's okay. Below 0.3 is definitely good. So it doesn't have to be zero. Of course, if it's zero, that's wonderful. You know, it's. But I mean, like, don't force yourself to have less than 0.3. Less than 0.3 is really good already. So you said don't generate strategy randomly. I think the best workflow for who have an idea is edge ratio workflow, clone plug that can choose all signals and indicators, find edge and improve that. For what I focus on creating, find best workflow, and I found edge ratio. So definitely a purposeful workflow is much better than random. Both will work. The only difference is your confidence is higher in a purposeful workflow. So in SQX, if I build a workflow that's trading breakouts or mean reversion, I know this is good. I have strategies that work. Even let's say you're starting from scratch. Let me give you a general idea. So breakouts, mean reversion, trend following, pairs trading, seasonalities, all these are robust methodologies. I don't need SPP or WFM to know. So if I start from that point of view and then let SQX give me variations of that. So probably me alone will think of a breakout just like the example we did. So it's a close greater than 2 ATR. That's in my head. But if I build a workflow around that, then SQX will bring me many variations of this. So maybe the moving average plus 2 standard deviation, 2 ATRs, or maybe the typical price plus 2 ATRs, or maybe the RSI2. So it will give me many variations on this. That's the advantage of SQX, but they're all following the same concept. When you do random, when you just go to builder and you just pick anything and you do randomly, the problem there is, of course, you will find something and probably it will be robust, but then maybe it's something obscure, like, I don't know, it will find something that you will never think of, and you think, well, this doesn't make sense. It doesn't have to make sense. I mean, if it's robust, it's robust. It's just psychologically you will have much better confidence in something that follows a working principle already in the market. So like I mentioned, we know, let's say, pair trading works. So if you try to find something that use pair trading, then you already know the thing is working, but just SQX will give you variations of that. So that's the only difference I have. Of course, again, if it's random and it's robust, then that's it. It's robust. And it doesn't hurt to mix both. Like, you don't have to stick with one. You do one and you do the other, and you mix them in a portfolio. So BTrader, can you explain again about mean reversion strategies and SPP? So SPP works as it changes all the variables and it plots the median for all the metrics. The methodology of SPP, the one I use, is you don't want to be too far from the median. If your strategy is too far from the median, then that strategy is not good, because that means most likely you're sitting on a peak. So let's see. So if this is, let's take profits, net profits. Okay, the median looks like, let's say this is the median. So if your let's say this is one standard deviation, or let's say this is two STD. If your strategy is here, of course you're not seeing this graph. SPP will just tell you how far you are from the median. Then most likely this is a peak and you should not expect this in the future. Your strategy would be somewhere in this area. So that's what SPP is doing. Now SPP is calculating the standard deviations, but it doesn't show you, it does not show you from the median. It shows you from the average. So let's see if we can, you see it's calculating from the average profit, but like I mentioned this many times, I'm working on this still, that we need this to be from the median. But you want more strategies to be less than one. Now, yes, it will be hard. Less than two, they are okay. So just like we mentioned, you need to rate your strategies. So let's say less than one is excellent. Let's say that's a score of 90 out of 100. And then less than two is like 70. And more than two, that's failed. You don't want to trade strategy that is more than two standard deviations away. So less than one is failing your strategies all the time. It's expected, because most strategies are garbage. So maybe you want to increase that. Start with, I don't know, 1.5. See what happens. See if you can find something. If you are not, reduce your number of variables. So if it's already one variable and it's not even passing 1.5, maybe that variable doesn't work alone. So yeah, there is no like one, there is no like one answer to this. There is no one solution. But SPP will fail most of your strategies, correct? Also WFM, but that's their that's their job.
Because the SPP in the other areas where it calculates median, it passes everything, but only that one, only the best optimization profit fails, as I put into the picture. Everything else in SPP and optimizing profile passes.
How many variables
Like
you
really
have in
good.
the strategy?
Two.
What are they?
Like various ATR and RSI and whichever. This normal. But I am thinking that how is that the most strict thing, this optimization profile, one standard deviation? Is that the if that fails, then it fails everything, because SPP passes in other senses.
Yeah, but see the problem here.
But is that the most important? Is
all of them are important, except this one. The problem is calculated with the average. For me, that's the problem.
Yes, that I get it. But can you see the problem that everything else passes pretty much? Of course, SPP will fail. Like maybe 90% of the strategies fail. That's okay. But if I put this on, this optimization profile profit, pretty much everything fails.
Yeah, so increase it, like I mentioned. Go to 1.5.
Yeah, but two is and 3 is, of course, everything passes.
No, 3 is too much. Above 2 it's too much already.
Much.
Yeah, above 2 that means. Yes. So here is
that means everything.
Yeah, here is what this means.
Because
you have to think of it.
It's a curvebell.
Yeah, so 2. Yeah, so we understand that 2 STD is
everything.
Yeah, it's too much. I mean, 2 STD is already 95. So if you're above 95, I mean, really the probability is 5% now that this will work in the future. Yeah,
exactly. But when you take my picture over there, so that is the optimization profile. So that is part of, and the system parameter permutation SPP itself, that passes, but this optimization profile doesn't pass, and it's in the SQX it says pass.
Yeah.
So
I would do this.
That's the problem for me.
Yeah, I would. The average why it's not correct, because you see something like this will pull the average up, so it will mess with the data, not like the median. And I honestly don't know why they have this, because all SPP is calculated on median, so I don't know why this is the average. But in any case, I would either switch this off and get the optimization data out in Excel. Like if you really like this strategy, you can find the median in Excel and find if you are within 1 or 2 standard deviations. Yeah, but in the beginning I would do this. I would like just go one step further, 1.5, 1.6, 1.7, all the way to 2, to find out okay how many of these are I'm getting between 1 and 2. And then you'll find, let's say 1.5 is a good threshold. Let's say 1.5 is a good threshold. Then take the strategy that passed 1.5 and go find the median for it to see if it really it's good or not. And then I will take it from there. But or you can do the other way around, which is the WFM. So find the strategies that passes, let's say 1.7 standard deviation, and go test them on WFM and see how many pass there. So that's like a confirmation from another calculation.
No, that is good. And SPP at minimum 5,000 runs, maybe 10,000 is better.
I wouldn't do less than 5.
10,000 is quite okay.
10, yeah. I mean, obviously the more the better, but right now it's capped at 20,000. But because you want to get as much.
Actually, you can run more. You can actually run more. Just put it 50,000 then, and it will run.
Yeah, but I think what's happening there, it's a repetition. The problem is we don't know how this is working, and so if Mark is saying more than 20,000 is not good, I'm assuming that's what's happening.
Yeah.
Because obviously it's not the computer power.
Yeah. So taking first here and then after SPP take it to the WFM.
No, I wouldn't like. This is just a test for you. So this is not a workflow. But I'm saying, okay, find out between 1.5 to 2 standard deviation. Find you want to find what's the threshold here that's good. I mean, 1 is good. Nothing passing 1. So 1.5, and let's say I have 100 strategies. Take those 100 to work forward matrix and see how many passes there. If 70 pass out of 100, then okay, I will take 1.5 from now on based on this workflow, because I tested it through another methodology, which obviously WFM is the same thing, is manipulating all the variables. It's not taking the median at that time. It's a different calculation.
Yeah, it's average.
Yeah, so there, like, it's like a confirmation in a different way. Once you find that, then you say, okay, well, let me stick with 1.4, and that past 1.4 here, it's good for me. That I will say excellent. That this is score 90, and then 2.4 will be score failed. So you can find the threshold for that particular workflow. But for any other workflow, I would start with definitely with 1.
Yeah, but this is now important. So if it doesn't pass this optimization profit, then it's garbage. The strategy.
Yes, you have to keep in mind you are testing something randomly. But if you're doing, like, let's say you're doing RSI. I know RSI works on the ES. If I bring RSI here and all of them are garbage, well, definitely then this is not correct. 1.4 is not correct, because like I told you, so there are certain methodologies you don't need to test robustness, like trend following, mean reversion, pair trading, bias or seasonality. We know these guys work. The problem is you need to pair it with the right market. But for example, if you come today and you pair RSI with ES and no robust strategy comes out of this, well, I know something is wrong. I know RSI works on ES. Like, I don't need robustness testing on that. If it's not coming out with robustness figures, then I have to now play with these figures to see, okay, what's wrong? Is it the number of trades? Is it the average trade? Like, I need to find out why it's failing, because now I'm coming from the other direction where I know it is robust and I want to know, okay, what? So this is, let's say, the general figures. Generally, if you don't know anything about any strategy, if you're just starting your trading journey, then these figures I will stick with these figures. But once you are experienced enough and you know, well, this methodology works, why it's failing SPP, well, now you need to play with these figures. Like, I can give you an example here. So this bias methodology, okay, this is seasonality on Monday on crude oil. If you go back 20 years, this works. I mean, when I say works, I mean it's produced profits. That doesn't mean it's 100% correct. Works in our language is it's profitable strategy. Now, if you take this to SPP, you have only one variable, which is time. Obviously, if you change the timing, if you go back 2 hours, if you go forward 5 hours, the strategy will fail. Yes, it will fail because the whole seasonality is in this period. So, but if you understand what seasonality is, then I don't need to do SPP on this. Now I have to look at other methodology to find the robustness, which is number of trades, okay, average trade, and the outliers. If I do the testing on this and you get this thing, percent of profitable trades is less than 30, then that's my methodology, okay? Or if most of the profits coming from 5 trades, I test this, the strategy is, let's say, producing $30,000 profit. But $25,000 came from 10 trades. That's not robust anymore. So robustness in seasonality, it's not calculated the same way as the robustness in this methodology. Because I know I cannot change the time. I know I cannot change the day. So now the only place I have is the average number of trades, average number of losers, the outliers. This is what I need to look at. So it's a different way to find the robustness. So this will not work definitely.
So in your previous video, you mentioned that there's a hedge fund which does weekly optimizations. How do they do their robustness testing?
For trend following, they don't do. It's already, the principle is done.
Trend following.
Yeah. You see, hedge funds have the problem of capital. They cannot go without trend following. I mean, there are only few hedge funds that trade short time. I'm not talking high frequency trading, because high frequency is only, they trade only the order flow. They don't trade like RSI or signals per se. There are some hedge funds that sits in the middle, let's say between 20 and $100 million, who do trade signals like we do, but they cannot do it short time frame. So they need to do it long time frame. So their methodologies to find robustness usually sits with a lot of trades. Like, because they have different tools, first of all, they can apply the same system to many strategies, not because of not too many instruments, not because of robustness, because of, again, capital. Imagine if you have even $10 million, it will be hard for you to buy one instrument without affecting the price or without like some execution algo. So their optimization, like their methodologies, I can tell you clearly, it doesn't apply. Whatever they are doing does not apply to us. Most small hedge funds will start with daily time frame, and the bigger they get, the more money they get, they start incorporating more trend following, more longer term strategies. Even RSI, they take now weekly signals instead of daily signals. So they get away from smaller time frame. Even after, I would say, $8 million, they will get away from smaller time frame. I built strategies to trade daily time frame, let's say on crude, and that was not enough. The liquidity was not enough. So even on crude, which is it's liquid in any way you look at it, it's not as liquid as the ES, but it's very liquid. But when you are deploying 100 million, then daily strategy on crude is not good enough. So you need weekly. Why weekly? Because it will take you a week to enter and exit. So your execution algo will take a week or 4 days to fill your order. So the only thing I found useful is, of course, they have excellent tools. So for example, we talked about now the correlation, finding out what's the best combination for a portfolio. Well, of course, there they excel because, first of all, they have their own programs. They build everything custom, and their tools are amazing there. Like you can say, I'm targeting a 10% drawdown. I have this data bank. Go find me the best solution, do Monte Carlo testing on them, and find me a portfolio within 98% confidence that I will not exceed 10% drawdown. And they have that tool. Why? Because always for the past, I would say 15, 20 years, the shift went from achieving more money to achieving less drawdown. So right now, if you go, like, let's say ISG, which is a database for all the hedge funds, so you see, let's say, good hedge funds producing 15%. It's not because they're stupid and, we can produce 40 and they cannot do it. They can do it. but the problem is drawdown. So in the 90s, drawdown was not important. 50% drawdown was acceptable for a hedge fund, because a hedge fund was only for the rich people. You need $5 million to get in. And so it was acceptable to have 50%. Nowadays, you cannot, because all pension funds and endowments, they invest with hedge funds. So 10% drawdown is a lot. So most of the tools now geared toward that, and of course we don't have, but that's what I've seen is, like I mentioned, you can target a portfolio with 98% confidence that you will not pass 10% drawdown. So, and even then, so this is another logic. So they have, let's say, another program on top of the portfolio controlling position sizing. So if you face, let's say you're trading 100 programs, and now on top of that, there is a risk control. If you go down 4%, they will reduce the allocation to all strategies by 10%. So even though they are targeting 10, they will not reach 10, because 10, that's they consider it the threshold that people will withdraw their money. And so their target, in reality, most they will get is 6, because they keep lowering the allocation, which of course in return going to lower the position size to even lower. So by the time you're 6% drawdown, you're probably trading 20% of the capital available. So yeah, they have all their tools, I would say, geared toward managing drawdown, because that's their enemy. Remember, they live on fees, so they always need more money, not less. So the profits doesn't matter. Last, I would say, 10, 15, 20 years. In the 90s, profit was the main goal.
That's very interesting. Yeah, I work in the insurance industry, and pension funds do specify all these criteria that you need to match. So if you break the covenants, then they'll move the money away from you.
And remember, these money don't come easy. They have I don't know, 6 meetings to acquire, to convince, let's say, they meet with the committee, and it's like a whole thing to get, let's say, I don't know, $500 million. So they will not lose that because they want to make more profits. Also, all these now endowments and pension funds, also they are not looking for high return, which is stupid, but that's the mentality. It's, at the end of the day, there is a people sitting at the board saying, okay, look, I want, if you give me 5% return, 4% drawdown, I'm happy. Even though inflation today is 6%, it doesn't matter. They don't care. Of course, that wasn't the case before. So now hedge funds, even like AHL, which is extremely smart hedge fund after Jim Simon. So AHL, they have, I don't know, 300 PhDs working for them, like chemical engineers and rocket scientists. And obviously they can produce 25% return. But because of, they manage 150 billion, they are restricted by their requirements. So their average return is 12%, which is still a lot, considering their drawdown. But I mean, they definitely can make more. But anyway, it's good for us. So that gives us the chance to make more money.
Ale, what is your when we aim, if we aim for the small drawdown, then there is, of course, this leverage to leverage to get better returns, as you have said. So, what are your means of getting leverage? Is it futures? Just trading futures, or that's the way to leverage?
In stocks you can borrow, obviously, from your broker, and depends on where you live and how big is your account, you'll get different interest rates. But even then, the maximum you go overnight is 2-to-1. So if you put a 100,000, they can give you 50,000. Okay. But in futures, it doesn't matter who you are. You're already getting anywhere between 5 to 15 times your amount of money. So I don't need any favor. I don't need to live in Chicago to get this. I can trade the future contract and I will get, let's say on average, 10 to 1 leverage. The most what's written in the public sphere, and people think leverage is very dangerous, which of course it is. It's just like giving a Ferrari to a 16 years old. Obviously we know it's very dangerous, but it's not the same like giving a Ferrari to a race driver. He knows how to use it. So that's the same thing. So I agree that the government trying to limit the people who use options or futures, but if you understand how to use it, then they're not, in fact, they're a lot less riskier than the others. So leverage, yeah, I would say futures is the best way to get leverage. Also, of course, intraday, you can get more leverage, but I will not go into that because that's then only trading intraday, closing end of day, which you can, but you will find out anyway that you don't need that leverage, because even with 15 to 1 leverage in futures, you will find that you don't trade all your money because you'll use risk parity, and then you'll find out that you don't use most of the money you have in your account anyway. But definitely you need leverage to grow your account. Without leverage, it will be a really long process. The idea is what? The idea is, in the beginning, I don't know your financial situations, you guys, but most likely you are not living off your trading. But let's say you are, you need a big account to live off your trading. If you are like living off $5,000 a month, that's $60,000 a year. And if you are living on $200,000 a year, that's definitely different requirement. So definitely in the beginning, I would say the target for anybody is $250,000. You need your account to be $250,000 in order to trade and get the returns that you can withdraw to live on. So to reach 250, let's say from 10, that's a long process if you are compounding at, I don't know, 8 or 15%. You need to grow at 30, 40%. So you can only do that with leverage. And so you need to understand how leverage works, how you use it. And definitely you need to switch to futures at that point.
Yeah. One more question for me, Ali. So with all the problems that are there in terms of trading size in hedge funds, what would be someone's motivation from going from individual trading to setting up a hedge fund?
More money. So same thing. I build systems. I can trade them with 1 million or 50 million. With 1 million, let's say my account is $1 million and I get 25% return. So I get $250,000 end of the year profits. Now, same systems, I can trade them with, let's say, $25 million more. And let's say this is you guys. Now you are depositing money with me to get 25% return. In return, I say, look guys, I'll give you 25 return and then I will pick 4% out of that. So instead of you making 25, you will make 21 and I will make 4%. But now I am making 4% on 25 million, which are not mine. So that's leverage for me. That's more money coming to me without me doing anything different. So it's like I leverage my $1 million to $25 million. So same amount of work, same everything, except now you're making more money. So that's the point of starting hedge fund.
Okay, yeah, that makes sense. Thank you.
With non-US, non-European registered FX broker I use, you can still get, yeah, but 500 to 1, you don't want that. I know you can get leverage with Forex, but that's crazy. Okay, I can I don't know what your system is. 500 to 1, you'll blow up. Guaranteed. That's just statistics, because at one point in time, a drawdown will blow up the account. A 100 to 1, a guaranteed blow up. So from the data we know, LCTM used 100 to 1. So that's the threshold. So we know 100 to 1 also blow up. So probably, I don't know. I mean, I haven't tested this, but the maximum I would go is maybe 25 to 1. And even then you need to test really, really hard with Monte Carlo to find out. We know 15 is the sweet spot because that's futures. And I've seen Owanda, which is a very respectable, they give maximum 40 to 1. And they don't trade against you. So I'm assuming that's a good threshold to start with, at least. But definitely between, let's say, 20 and 40. So remember, 500 to 1, that broker is trading against you. That's a guaranteed bet that I will win against you. I will take that trade any day of the week. That's what they say. So any broker offering you 500 to 1, he's trading against you and he will win at the end of the day. When brokers that they don't trade against you, they should offer you less than 50. So again, like I mentioned, I know Awanda's 40. If you deposit $1 million, they give you 40. So that's good. But I would say 20 to 40, stick there. But even then, do like your testing. Above 40, I would say you blow up. I don't know what's the probability. But LCTM, which has 2 Nobel winners, math geniuses, and they made 45% for 4 years in a row, and then they blew up. And they were doing 100 to 1. Can I test this inside SQX to find the leverage? No. You need Monte Carlo testing. So the only way to find your risk of ruin, hence the capital required, is through Monte Carlo, and the one in SQX will not do that. The one in the analyzer, I forgot the name, that can give you an indication. The one in Market System Analyzer is the best that I used in retail. And I mean, that one is $300, I think. If you're at that stage, it's worth it. If you are not trading $10,000 account, then it's not worth it. And of course, if you have $1 million, then there are much better tools, but they will cost a lot. But just like in the beginning, just listen. Don't go about. If you're just starting and you don't even know how to get to this calculation, just use 15 to 1. Okay.
So then roughly 15,000-20,000 per 1 ES in it.
No, I'm talking about the leverage for Forex. When you're trading futures, it's already built in. You don't need to do anything. When you're trading one crude oil contract, you're already, I think, I forgot now the leverage, but they're all between 8 and 15. And so it's already leveraged, so you don't need to do anything.
Yeah, in the initial and the deposit.
Yeah, but you will need to do the Monte Carlo anyway, because you want to find out, because remember, there is a margin requirement. And if you fall below that margin, you cannot trade. So then your Monte Carlo is not about leverage per se, it's about staying alive to trade. And that's risk of ruin. They both, lead you to the same conclusion, which is you need this much of money to trade this many contracts. And like regardless of what you're trading, Monte Carlo will give you that, the right software. So the only one I have now, and even though I have no affiliation with the guy, he is the best retail package available today, which is the Market System Analyzer. That one will give you an accurate picture. Of course, this can be done in Excel again. Just, to make things easier, probably you can use that package.